good morning, or good afternoon for you, I suppose. Morning for me.
Indeed. Again, I appreciate you, carving out some time for us around the ski slopes to talk. So, and we have to talk to you because you're one of the few people out of consensus right now. And the way that the last, 8 weeks have broken, there's massive inflows into the S&P, consensus around soft landing or no landing and all the rest of it. You sticking with your guns here?
To an extent, when I wrote that forecast of trading down to 4,100, that was before the Fed's earlier than expected pivot. So the probability of getting all the way down to 4,100 is a bit lower than it was when I wrote that at the beginning of December. But nonetheless, I do think the beginning of the year will be more difficult than, current price actions would imply. There's a couple things going on that I think are important relative to thinking about this Fed policy reaction function. First of all, if they truly have pivoted back to inflation being both the necessary and sufficient condition for rate cuts, one of the key flaws in the way that they're looking at things right now is that the disinflation we've seen is being entirely driven by goods prices. So core goods prices in the CPI measure are falling at a 2.5% annualized rate.
Wow.
That's almost as fast as 2003 when China first got admitted to WTO.
Wow.
I doubt very much that's going to persist. It's a second wave of deflation coming out of China, and as a consequence of the big move in the dollar, the dollar is already reversed and has weakened a lot since the Fed's pivot. And there's a lot of signs that global trade is starting to pick back up. Global manufacturing could come out of recession. I look at the Asian trade data, the Korean numbers, Taiwanese numbers and all, and they look like they've all turned positive. So I think if the Fed is counting on goods deflation offsetting, the struggles of housing inflation and core services, I think they're likely to be somewhat disappointed, which then means in order to get the level of easing that I think we need next year in order to open the bank credit channel that is closed in large part because of the deep curve inversion, you're going to need the unemployment rate to go up.
Right.
I think it'll happen, but that's not a happy environment for stocks either, really.
No, for sure. And I think it's interesting what you said that, both things can't happen. If people think manufacturing is going to turn a corner, then we should stop having core goods price deflation. And so if manufacturing turns a corner, then inflation may be stickier. So is that kind of how you come around to it?
Correct. I mean, ultimately, for me, I think there's a possibility we could get, inflation, the core below 3 for a brief period of time. But I think there's a very low probability we get all the way to 2 when Steve sends out his survey before Leisman, that is, before every meeting. I'm one of those participants that says, I don't see inflation getting to 2 anytime in the forecast horizon. So in which case, listen, I think if they got it below 3, that would be fine. They should still be moving some of the restrictiveness from policy. But I think the Fed will probably be reticent to do that unless the unemployment rate goes up, in which case the earnings outlook is a little overly optimistic. So
exactly,
it's still a very narrow path to have everything work out the way the stock market currently is implying, or Treasury market.